All right, traders, welcome to today's recap. This is Christian from Hertz Tribeca Trade Group, and it is Friday, May 24th, the day before, or the last trading day before the long weekend. We'll talk a little bit about that. I wanted to wish everybody a happy Memorial Day as well, and make sure that you do something fun this weekend. This has been kind of a tough couple of weeks trading. This is the third week in a row that the indices have been down, so I think it's a good place to kind of reset. It's not exactly the end of the month, but I think at this point the markets need a little bit of a breather. Just they look a little bit, stressed. I think everybody's a little bit kind of feeling the same way about the headline risk and so forth. So I actually think an extra day might actually help. But more important, make sure you go outside, you get some vacation, you do something fun, whether it's have a drink, whatever. But and also these types of weeks, right? What we've been seeing in May versus the rest of the year, there's definitely lessons to be learned about holding winners and riding trends, which is, something that I am very good at, I think, and finding those trends. The last couple of weeks, this is really where you learn things, right? This is a little bit more difficult. Choppy markets, more markets that are trending down. This is where you actually become better as a trader and you learn some valuable lessons. For me, and I'll tell you, in any one of these sustained moves, and I think over 3 weeks now, you could say that this has been a sustained move from high to where we are. It's been tough because there hasn't really been any light at the end of the tunnel. But some of the lessons that I think are takeaways from this is to continue to be objective about what this market could possibly do, up or down. Don't stay perma anything. And when there's a little bit more, uncertainty in your analysis, right? There's always uncertainty in the markets, right? But maybe uncertainty in terms of the trend and so forth. You lighten up your risk and you trade less, you take less position size. You could still participate. You could trick yourself a little bit, which is what I do, right? If I still want to be in the market and observing and watching and looking for the next signal and trading a little bit, you just tone down your trade size, and this way you're not getting hurt. Now you're capping your reward too, but I think in this market right now, until we show a little bit better direction than this, I think that's the right tactic to take. So, though, again, this is the time to be learning and writing down things. If you keep track of things in a notebook or journal, you want to be kind of filling in some things and taking away what happens, whether it be, and there's a couple different right things that you could use, right? The reason why I have moving averages and value areas. Once we broke the bottom of value, that could be that's an area for me to get more defensive, or was an area for me to get trade a little bit less. Also breaking of the moving averages, the 20-day moving average or the 50-day moving average. It really doesn't. I don't think it matters all that much which one of these that you use. The tighter moving average or faster moving average, that one will really get you out of the market quicker when we do break those things. But you could be using any one of these, and as long as you incorporate that into your trading plan. So where are we now, right? And we'll kind of cover the day. But before, I want to cover the price action for the day, which I had up there. But we haven't broken trend yet, and I'm going to go to that on the weekly chart. The level that I keep throwing out there, and we did close above it, right? So it's 28.1775. You probably, if you've been a regular viewer of my videos, then you know that I've been saying 28.1775 for a couple of weeks now, because we actually touched this 3 times. So that's where the S&P is. If you go back to the daily chart, and I won't spend too much time here because I've been talking about these all week. Is there any takeaway from this? Maybe a slight higher low here in the S&P, but I don't think you could really, as I like to say, hang your hat on anything here, because you really want us to see You want to see price kind of retake some levels, and when we haven't done that right now, we're just kind of hanging on. So, and just same thing with that weekly level. Good to see it above, but we're certainly not far above it, and all it will take is one day to either break that level, or one day to possibly get away from it. The Qs, this was a little bit of the problem area today. It did, everything bounced a little bit. I think Qs were up the most starting the day, or around. I'm sorry, I shouldn't say that. I don't think they were up that much, but they certainly came in the most. And for a while the Qs and S&P have looked very similar. We'll see if that remains. The Qs were higher up, so they had more to fall into the support. But again, another level that you've been hearing me talk about, 176.19. Now, if these levels hold, then it's a standard. We talked about this in the trading room this morning. Then it's just a standard correction, and there's nothing wrong with that. You're supposed to actually have corrections during the year. That's just a normal occurrence. So right now, what we have is kind of a normal occurrence for most for the S&P and for the Qs. IWM is different. That bounced a little bit today. Not enough to really, like I said before, kind of hang your hat on anything. We don't have a hammer bar in the weekly, so you can't really take away from that. And we held this support. I would be mindful of this virgin point of control down here. But again, we didn't take back any moving average here. So that's just bottom line. I wish I could say that we kind of came up with a bunch of conclusions at the end of this week. You don't, and that's just part of doing the analysis and realizing that you don't have anything there. What I'm going through and what I went through in last night's video too, which was a bunch of different things, we just don't have anything to say, this is a place for me to take risk, or this is really, basically it for the long side. So you just need a little bit more time. Now, again, maybe a 3-day weekend helps for that matter. The other thing that I noticed is, without really going into all the option activity, which I know people love to look at, but if you just follow price, because again, there's a lot of people who look at option activity, but it's also stock activity, right? Cash trading that drives the market as well. And I think you could kind of come to a conclusion here that what happened today. Again, there's more distribution going on. There's more selling going on. So why would I make that conclusion? Just very simple. This is percentage change again from the open. And what happened? The only thing IWM, again, which bounced a little bit, you could see the banks actually bounce the most. Remember, the financials are the biggest weight in small caps. But look at SPY, look at Qs. Does it make sense? Can you kind of rationalize why the Qs were down 60 basis points? Well, the long weekend, I think it's very logical. I think people trade, when I say people, traders, they're not going to want exposure to technology over the weekend with the way that the headlines have been coming out. Now, how much more do people sell technology that was originally a couple weeks ago overcrowded? It all depends. It all depends if just people do not want to be in that, holding that type of risk, regardless right now, or continued high beta, because I think some things that are being sold are also less trade sensitive, but they're also just traders just do not want exposure to them right now. Now, again, at some point there'll become buying opportunities. I was listening to, I think it's Dan Niles was talking about, dipping his toe in and buying a couple semiconductors. That could be kind of, and again, I'm not putting him in the boat of everybody, but that's what basically has to happen, is people have to start saying, hey, these things are becoming interesting signals right now. What else? Kind of the home builders were up there too. They were up 1.2% from the open. But man, look at the energy companies. The semiconductors also were sold off. Also, the other thing that I have down here is FANG. All the FANG stocks got hit today after the open. So some of them started the day, like Amazon started the day close to up 1%, and that was sold off. So again, Amazon has been there's been, I would say, distribution days almost every day this week. Microsoft, Netflix was the only one that held up fairly decently. Google was down 1.2%. from the opening print. So that should tell you. I mean, that picture kind of tells you that, right now traders don't want exposure in it. And my thought is, especially over a long weekend, given that just one night anything could happen, but we are living in a headline frenzy environment right now. So what else to go through? I mean, I think that covers a lot of the things. I did want to talk about the week's performance, which I like to do this on a Friday. I like to go over, first of all, the major indices. And again, if you are newer to watching my videos, I'm not really a negative person, but when it comes to managing risk and so forth, like the great Paul Tudor Jones, you always want to be worried about where you could get hit. So if I do have long positions, I'm always worried about what looks worse, what looks bad, So I'll always kind of take a negative stance a little bit to the fact that I'm worried about things more worried about things to the downside than things moving to the upside. If I was short, then I would be saying, "Oh, I'm really worried about what could move up." So let's compare last week's performance again. As I mentioned in the beginning of the video, it's the third week of called again distribution or of selling pressure. SPY finished down 1%. The diamonds were only down 0.5% this week. By the way, so this line that I have drawn in here is this week's performance. The above this particular line is the prior week, just so you have a frame of reference. Small caps again finished down 1.3% versus 2.4% the prior week. Really, the Qs got hit. I think again with what's going on in China, you can imagine why that's getting hit so hard. Emerging markets, after a horrible week, the week before down 4%, also finished in the red. The only thing, bonds were up 1.4%, and gold turned around and bounced again on the 200-day moving average and finished up 0.5%. So, like I said, third week in a row. Let's move to the performance. There was a couple bright spots in performance. The previous week it wasn't so hot, but clearly the defensives, even the solar names, were actually up 1%. Healthcare a little bit different. I went long some healthcare this week, thinking that could kind of join the defensive party. I just think that this group really hasn't done much at all. So, and looking at the charts, they look slightly better than some of the other groups, and I'll bring those up once I go through all the performance. But and then utilities, of course. Again, maybe looking at a toppy-looking candle, which I looked at this earlier in the week, and I kind of thought the same, possibly here. But I would also couple this with one candlestick is not a pattern. So you just kind of have to wait and see if this breaks one of the moving averages. I use the 5-period moving average, 5-period exponential moving average. That'll tell me if something is different, because you've had a couple toppy looking candles in here, but that hasn't changed the trend at all. But this one looks a little bit more severe than these two, but who knows? I said I would mention while I've got charts up, I might as well look at XLV. It's getting there. It still needs a little bit more work. I needed this. Let's see where this closed for the week. I wanted this to close inside value for the year. Close above value. Not quite there. So it's got to do a little bit more work. It's got to push a little bit more. And then, I think more things will come to life. But I'm going to come back to the health. More things will come to life in the sector, but I'm going to come back to healthcare, and I'm going to look at some other charts, kind of look under the hood, and look at some subsectors there. Look at the performance this week of flipping to the names that underperformed. Look at the performance in the energy space as crude got beaten up pretty hard this week. OIH was down 8.5%, XOP down 8%. Just really nasty stuff. And if you remember, most of this year, energy just has not been able to get going at all. Talk about relative weakness and underperformance. Even when the market was going up for the first quarter plus of this year, energy stocks could not, turn the corner. They had maybe just small couple days of outperformance here and there, but really difficult. And I would say, a lot of people, including myself, talked about some call buying in some energy names. Man, those hedge funds are getting smoked. Whoever's been buying calls and things like MPC and some of the smaller cap names that I think what CVE is maybe another one. There's like a handful of them that there's been call buyers in, and again, you always have to go back to hedge fund performance. That's why they're not outperforming the major indices, is because they've been buying things like energy stocks that have gotten walloped this year. Chinese internet's down again. They were the worst group. I think they've been the worst group now 3 weeks in a row or close to it. So they were down another. So I would say close to it. They're not on the top of the list this week, but down another 7%. Just nasty. And the semis down 5.7%. Metals and mining, which also has had a horrible year. The XME ETF down 5%. Again, a lot of steel names are in that group. Robotic stocks, the transports got hit hard. Tech got hit hard. So again, a lot of groups down more than 2% and very little. With two defensive groups up more than 1%. So again, very bad market breadth for the week. International, some signs of actually a little bit better market breadth this week. Brazil, if you remember, Brazil was the worst international area this week. Last week in terms of performance, was down 8% the week prior. Came back somewhat, 6%. I still don't like this chart. I was looking at this before I did the video. It's kind of just moving up into resistance. So the one-star performer, you could look at India, which got a nice bounce. Still not really making headway here in terms of making a 52-week high or anything like that. You could look at this one as well. So maybe something to watch for some international area to come out and make new highs for this year. But the silver line or the, I guess what silver lining, is that right? Is that a right way to say it? Or is maybe the positive is to see finally something, better looking than the U.S. to see some groups up, up 5%, up 6%, up 3%. Indonesia also up. But man, they got smoked the last couple weeks. So again, that doesn't look great. So some of these just look like a decent bounce from being hit very, very hard over the last month. So again, nothing to really say very positive here. So looking at the U.S., looking at international, not a ton of things. So let's look at a couple other things, and then we'll call it a weekend, long weekend. What did bad this week? South Africa did bad again. China down another 2.5%. Emerging markets, levels to watch for next week. Again, price action, even though this was up 10 basis points, not recovering any of the short-term trend. Short-term trend is still down. You could use simply, again, the five-period exponential moving average that the price is below. So no change in trend whatsoever there. The level to watch, which again I've been quoting this one just like with the Qs and with S&P, 39.63. All right, and so that covers international. I did want to go through. I'll start with healthcare because I think it's one of the better. Again, this is not looking great, but it's looking, I think, a little bit better than some of the other sectors that are out there. Some of the other riskier sectors. There. By the way, here's the chart of. Speaking of that, I just wanted to update this. This is something also that I've been talking about a lot: is low volatility versus high beta. Very interesting, I think, that it reached so far. The peak was yesterday. And the peak was 1220. the last time that this group was very hot as well. So will this mark another area of maybe it's it for the super defensives like insurance names and electric or utility names and so forth? So we'll see. We'll be keeping an eye on this relationship next week. IHI again, still below the 50-day moving average, but trying to come out here. A couple names that was watching was Abbott. Nice to see Abbott. Abbott's one of the names that I really like in medical devices. Nice day for this today. If we just move to a few other ones, just to see how this one, I don't like how this one closed, but Thermo Fisher. What's another? A couple other ones that I've been looking at. Baxter, no, don't like that. Um, Boston Scientific, not bad, right? Not a bad looking move. Back above the 50-day moving average. Has to get through value, but I still think this is progress. A couple other ones. IDEX Labs. Finally, something that's hitting a 52-week high. And of course, Thinkorswim won't let me look at it. The one name. So, there we go. Yeah. So new high for IDEX Labs. The other one that I've been watching, I don't have a position in it, is Zoetis. I don't know. Hit a 52-week high and then did not close there. So I'm afraid that might be a failed breakout, but too early to tell that. So we'll watch where that goes next week. So that's the one group I'm watching. If you look at the other, if you look at the equally weighted biotech ETF, a nice day, up 1.3%, still buried below value. Also, IBB did not get into value yet, was up 40 basis points, but failed to close on the highs. Let's just jump through the rest of the sectors. XLK not looking great. IGV also not looking good. This is below the 50-day moving average. So again, this is, while I'm talking about software, right? We had a couple names that reported. I'll bring up the Splunk chart in just a second. But this is, the last time that this got underneath the 50-day moving average, which is the purple line here, it bounced right back. Notice it did not make a new high when it came through here. So very easy level to watch is right around 210 for next week. If the software group breaks 210, I would watch out, and we may be losing market leadership. So just to go through, I'll start with Splunk. Autodesk also reported. Splunk, I think, is at an interesting level. It did close off the lows. Notice it took out this version point of control. So if you wanted to try a trade in Splunk, basically you could just use this version point of control or 200-day moving average, or just the low of the day. I think that's a good way to look at it for Splunk. A name that did not have bad results, but analyst expectations were probably a little bit too high. Salesforce reports, not this week, but next week. I think it's June 4th. We'll see what this could do. It's been having some difficulties here, but I'm looking for a run into earnings. But we'll see how this holds. It's a lot of consolidation on this lower band of that range. Workday reports beginning of next week. Nice move, doing what Workday usually does, which is run into the quarter. So we'll see how that reports. That could also provide some direction for the group. A few other names. Zen is also holding in pretty well in a tough tape. ZS up 40 basis points, holding the 20-day moving average. I think this one reports next week too. Twilio holding that top of value. So Twilio does not look bad. You don't get that many opportunities to buy Twilio on the dip. So that's a name I'll be watching next week. Just to change groups a little bit, PayPal is another name that is into the top of value. So another name that's dipping a little bit. And I like that. You just don't get a lot of opportunities in some of these names. So I'll be looking at kind of these best of class names next week, some healthcare and some other groups going into next week. So we'll leave it there for the weekend. Again, we'll be looking forward to next week's trading. Maybe things can pick up a little bit. In terms of getting this negativeness out of the market system. And we'll see what happens once we get through the weekend. But if you're not a member of Tribeca Trade Group and you like this analysis, we do more. I provide much more color during the days. So you can visit us at tribecatradegroup.com. And I think that would be a great way if you have not experience what we do on a day-to-day basis. We are here to help, to try to help traders so that they don't take too much risk. Again, I can't give any recommendations or advice, but you could basically follow my portfolio real time, and what we're doing and what I'm trading and whether or not I'm going to take risk, or I feel it's a time to kind of step off and not take too much risk. I could tell you this week has been a very light trading week for me as I'm waiting for more evidence and giving things a little bit more time. Again, most market corrections, they usually last, down 4 to 5%. So right now, as we talked in the beginning of the video, this is quite normal. We'll see if it starts to get more crazy next week and become more out of the ordinary next week. So we'll leave it there. Have a great week. Have a great long weekend, everybody, and I'll see you guys back on Tuesday.